Hi. So I think it's the time of the year again where we essentially update all our valuation models around the portfolio of companies that we own. And I think without a doubt, because you saw the video title, we are here to look deeper into the valuation of model around Alibaba Group Holdings. And just a disclaimer out there, I'm a huge Alibaba bull if you don't know by now. So Alibaba remains and it still is my biggest position in my entire portfolio. And because of its performance, it has been dragging quite a fair bit of the performance down. But anyhow, I think before I dive deeper into the numbers, I just wanted to go back to the key stats section here. So I essentially pulled out this Excel from Capital IQ, which is provided by S&P Global. They're essentially a data aggregation tool or a software platform. And you can see that based on this prediction or this forward analyst expectations. I believe this Excel was put out in early 2022, so it has been 1 year now. And based on their forward prediction back then, based on 31st March 2023, the expected revenue growth rate of Alibaba was around 12.73%. And they are expected to bring in around $144 billion in USD because this is based on the trading currency of BABA, which is USD. And of course, Alibaba has just recently released their results, and according to the March quarter year-on-year growth rate, it was much closer to 2% and not 13 or 12.73%. So you can see that many analysts out here, even though they're working in Wall Street, they have MBAs, they have whatever kind of degrees or whatever kind of educational background and qualifications under their belt, nobody have a clue about future expectations. If not, all of us would be billionaires. But anyhow, I think I just wanted to update or run you guys through this model in real time. You edit it together with me so that you know I didn't do any hanky-panky or do some magic here and there. But that said, there is two specific models we are using here. One is the EV to EBITDA approach. The other one is a DCF approach. So we will run you through one by one. But first, I think let's just kind of put in the numbers first to really do some expectations and compare year-on-year figures. So I think there is some mismatch here for the EV to EBITDA approach because we are using USD, and you guys know FX has been a great headwind for many of these transnational or multinational companies. Just ignore for the fact that in terms of the USD denomination first, I think the DCF approach is better because it's under renminbi. So I've got great news for existing Momo users. Currently, Momo is running an existing user promotion where you deposit or transfer fresh funds or stocks into your Momo account and keep that amount for at least 60 days. And you'll get up to 200 Singapore dollars worth of cash coupons, which will be delivered in-app at the end of this entire campaign period itself. So I will essentially quickly flash the table that illustrates the reward rules. And the best part is that the amount are actually cumulative. This actually means that if you deposit or transfer a total of more than 50,000 Singapore dollars, you'll get a total of $200 worth of cash coupons. Sounds good, right? So at Momo, you can also use 8 advanced order types to take profit and even stop loss. So for example, you can actually use the trailing stop loss limit order. So this specific type of order is designed to allow an investor to specify a limit on the maximum possible loss and also setting a limit on the maximum possible gain. So for new users who have yet to create an account with Momo, what are you waiting for? I seriously don't know. So there is an ongoing amazing promotion campaign reward till 31st of May 2023, and you can get rewards worth up to 208 Singapore dollars for new users specifically. So don't let this sweet deal get away so easily. And of course, time is ticking, there's not much time left in May. So for my US and Australian viewers, Momo is also running other promotions with free stocks as well. So just make sure you click on the correct link down below. So a big shout out to Momo for sponsoring this video. But anyway, I think just to populate it, based on the revenue growth rate that Alibaba has posted, 868,687. 868,687. Multiplied by the exchange rate of 0.14 that we used, it's around 1 to 1. So if you have to look at the growth rates, I'll just do a quick calculation here. It's around negative 0.52%. But we know based on the renminbi denomination, it's up 2% year on year. So in terms of the EBITDA they reported, the adjusted EBITDA they reported is around 147,911. Similarly, let's do 147,911 multiplied by 0.14. So that's around 20. Let's look at the EBITDA margin. according to the calculations, it's 17%. So we do see some sort of normalizing in terms of the EBITDA margin going upwards because of the cost control and structure and whatnot. So then we also have to include the cash and debt because we want to arrive to the enterprise value of Alibaba. So in terms of cash, let me do a quick search from there. Yeah, so the net cash position here we have is around, in terms of USD, 58,093. And then we have the debt, short term and long term. We need to go to this. Let's go to the balance sheet. Yeah, here. So let's go to the liabilities portion. So they do have a few things that you have to take into account. Personally, I use current bank borrowings and the unsecured senior notes. So let's do a quick calculation here. 1087 plus 699, and you have to plus the non-current one as well. So non-current bank borrowings is around 7575, and then you add in the non-current unsecured senior notes, 14134. So yeah, you get around the total debt of around 23,495. So then you have to repopulate the data because based on our calculations, year 2 of our forecast back then was 2023. So you'll just do this. The revenue is here. It's negative 5%, and yeah, the EBITDA margin is here. So yeah, it will auto-populate itself. This will be here. So then let me gray out this area just for easier visualization purposes. Oops. Yeah. Okay, so this is basically essentially the forecast. Let's just ignore the bear and the bull case first. Let's just look at the base case. So in terms of the base case wise, my calculations are fairly simple. I'm expecting, at least in 2024, which is the upcoming 1 year, there will be some sort of a stronger recovery because of the entire COVID reopening and whatnot. And I think back to the analyst projections back then, why did they have such a optimistic projection of the future? Maybe they were kind of accounting for some sort of reopening and China recovery phase, but evidently it didn't came. It came much later, which is the earlier part of this year. So let's hope that this drives into 2024, and that's why I expected a 12.5 and then a 10% increase. Not perpetually, but this is just a very short 5-year projection. So then in terms of my long-term EBITDA margin wise, I do expect them to kind of normalize back to 20%. I think at least for a tech company, based on the historical numbers and how they've been optimizing their cost structure, I'm expecting a long-term, or at least a terminal 20% EBITDA margin. So then I get to a market multiple of 18. The enterprise value at year 5 is this figure. The market cap is less debt plus cash. So in terms of the less debt plus cash, I need to readjust the figure because I've updated the latest one. So less debt plus cash, current outstanding shares based on the initial figure, the fully diluted shares expecting or assuming that they buy back 1% every year. The stock price at year 5 is 247, and the current stock price actually, if you do a quick Google search, is actually 81. So let's put it at 81. And the CAGR you're expecting is 32%. Assuming that the market prices it effectively, the growth rate assumptions stays there, the EBITDA margin is correct of 20%, and the market actually do award Alibaba with a long-term market multiple of 18 times EV to EBITDA. And honestly, just do a quick Google search, right, of EV EBITDA. Let's just say Alibaba EV to EBITDA right now. It's around 7.65 times. I mean, this is based on Guru Focus. It's around there. If I'm not wrong, it's around 8 to 9 times. So would the market give them 18 times in the long term, or at least 3 years out from now? We don't know. Oh, by the way, I think I miscalculated. For the CAGR, it should be divided by 3 because 1 year has passed, and yeah, the CAGR you're expecting is actually 45%. Assuming, likewise, all the assumptions stay true. Now, moving on to the free cash flow multiple. Similarly, this is the past few years data, 2016 to 2021. 2022 is grayed out because it was last updated last year. So now we will put in the 2023 figures. The growth rate, I'm not too sure. Let me just feed in the free cash flow figures first. Let me find statement of cash flow. Yes. So in terms of the statement of cash flow, the free cash flow for Alibaba in 2023 was 171,663. So yes, this was a huge beat or at least a huge movement compared to the previous quarter or previous year. I'll just show you what's the difference. Yes, it's a 74% increase. There was some distortion in terms of the cash flow for 2022. This sort of growth rate is not sustainable. I know it myself, but I think generally, at least from the first 6 months or the first half of 2023, you can see that if I were to compare the first half, I'm not too sure whether this is too small. But yes, you can see that I did compare the two figures here. 6 months ended 2021 and 2022, 42,922 versus 57,882. So that's how I got around a 35% increase. But yeah, evidently in the last 2 quarters, there was this huge uptick. That's why free cash flow essentially rebounded. So assuming that they can hold out the free cash flow movement, 30%, 15%, 15%, and assuming that they give them a long-term free cash flow multiple of 20 times, using a 15% discount rate and the shares outstanding, the expected share price currently should be 185. And 185, presuming that if you hold on for the next 3 years or however long, at least the terminal value I calculated is for the next 3 years, the discount rate of 15%, they're expected to give you a 15% return, and it's still 56% undervalued. This is the expected share price at year 5. Or actually, I should discount it by 3 years instead. So it's 281. So if you were to just take a simple average based on the stock price of year 5, 250 to 281, it's probably around that range of around 250, 260, especially in year 5, which is 3 years from now, 2024, 25, 26. In 2026, Alibaba should be around 250 to 280. That's based on my own projections, assumptions, and whatnot. So do feel free to leave in the comment section down below what's your own price target or price expectations and growth rate targets, etc. for Alibaba Group. I still think that they are fundamentally undervalued. Of course, people can argue till the cows come home. They don't deserve such a high valuation multiple. There's the China risk, there's the geopolitics risk. China's business is probably not going to grow at this rate. I think we will only know after time passes, or we only can look at it in retrospect. But then I just wanted to kind of answer one last question about this idea of free cash flow multiple. So this multiple of 20 times, this is the price to free cash flow multiple. So why did I use 20 times? So I think if you were to reverse it or inverse it, 1 over 20, that's around 5%. So by 5%, what this 5% means is that I'm assuming at the terminal growth rate or at the terminal multiple, Alibaba is trading at a 5% free cash flow yield. And some of you might think, hey, what does 5% free cash flow yield mean? Is it too high, too low? Is it too much, too little? I think at least for people investing in the stock market for quite some time, if you look at matured companies, your FANG stocks, FANG-M, many of them are trading at, or at least trading at a much lower multiples. They are trading at 2%, 3% yield. And your very, very high growth rate, crazy companies like Nvidia, it's probably closer to like point something percent yield. So I think at least at the maturity stage, a 5% free cash flow yield is probably, I guess, conservative. I don't know. If you want to be even more conservative, you can put like 15 times or something. But that said, I think Alibaba is much closer to like 8 times or 10 times or 8 times free cash flow multiple. And even at 10 times, which I don't think Alibaba should be traded at such a low multiple, it's still probably undervalued. And 8 times, it's still undervalued. In terms of a margin of safety wise and my expectations for the growth rates for Alibaba moving forward in the next 3 years. So do feel free to leave in the comment section down below what do you think of this entire valuation around Baba today. And I'll see you in the next video. But more importantly, I'll finally see you on the moon. Goodbye.